Today's podcast is sponsored by Fintool. Still control Fing through SEC filings? There's a better way. Meet Fintool, the ChatGPT for SEC filings and earnings transcripts. Just ask your question, and Fintool pulls the best answer from relevant documents, whether it's a snippet from an earnings call or a key point from a filing. The best part, every answer comes with sources, so you know exactly where the information came from. That's their read, but let me give you a little bit of my experience. I've been really interested in gaming stocks recently, so I was looking at Caesars, and Caesars has been built up through a slew of mergers over the year. I wanted to see their thoughts on how the synergies from these mergers had evolved to kind of judge them on these mergers. Previously, that would have been a half-day project. I need to pull up every earnings call for the past 5 years. I need to go through it, control F for synergies, probably read through it because sometimes they don't say synergies directly. They say like merger benefits or something. And I'd have to go through all of them and see how the thoughts on synergies had evolved. But with Fintool, it only takes 2 seconds. I just say, what did Caesar say about their Eldorado deal synergies? And Fintool gives me a quote and a link to the source. In this case, it points me to Caesar's 2023 proxy that's noted they'd exceeded their stated synergy target. And then if I want to do more, I can ask them some different questions and find out more about how the synergies have evolved over time. Good luck finding that with Control F in just 2 seconds. So look, if you're an analyst or a portfolio manager, try Fintool today at fintool.com and take your research to the next level. That's fintool.com. All right, hello, and welcome to yet another value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on Alex. Do you know what number time it is?
Oh gosh,
I don't know.
Got to be at least like 5, right?
Do you have the shirt yet?
No, you never sent me this shirt. I don't.
Okay, well, we're going to say it's the 5th time, and he's getting the 5-timer club shirt for this one. But with me today, I'm happy to have from the Science of Hitting my friend Alex Morris. Alex, how's it going?
Good, thanks. I haven't spent enough time talking about Berkshire lately with this book, so let's talk about this. Talk about this letter.
Alex is front running the host, but that's why he's on here. We'll talk about that in 1 second. But before we get started, a quick disclaimer: remind everyone nothing on this podcast is investing advice. We're going to talk through. We're talking about Berkshire today, so we might hit a lot of companies. Disclaimer, small position in Berkshire from some legacy accounts over here. Alex, actually, I'm pretty sure if I remember, the Science of Hitting has a position as well. So there you go. You've got the disclaimer. You've got the bias out. Alex wrote a book on Berkshire, Buffett and Munger Unplugged. That's why I figured he was the perfect person to pop on. Berkshire released their annual letter last Saturday. Alex is popping on to talk about it with us for 30 or 45 minutes. So 2025 Berkshire annual letter. Alex, I'll just toss it over to you. First thoughts.
Yeah, I mean, I guess this happens every year now as time goes by. The letter, it's interesting. It seems to, this one in particular to me, and I guess I should have gone back and read some of the past handful of years, but this one seemed to cover a lot of ground, a lot of interesting ground. There were some things that were kind of the tried and true shareholder letter type of discussions. There were other things that seemed interestingly placed in the letter, or in terms of just appearing in the letter at all, struck me as kind of interesting. And then there were a couple of Warren Buffett things that I get. It's like for the groupies, like the people like us, we nitpick at a couple things, and from his perspective, I appreciate that he sees himself as writing it to a broader audience. But there's some of the typical Warren things where you read it and go like, "Come on, man! Like we would have loved a little bit more here."
Well, actually, you hit on several interesting things I want to talk about. But let me just ask you, because you are in a unique perspective. You spent most of the past, maybe not most, but you spent a lot of the past year writing or editing a collection of Berkshire annual meeting transcripts. And then you've spent, I'm going to be fair, most of the past month or two doing the podcast circuit, promoting, talking about Berkshire and everything. So you've been thinking about Berkshire a lot. And I just want to ask, most of us don't have Berkshire top of mind like 365 days a month. As somebody who has Berkshire top of mind for a lot of the recent past, was there anything different when you read this letter that kind of jumped out at you, just in terms of, this is something he's always harping on, or this is a new point he made? Was there anything different to how you read it this year?
Again, I'd have to go back and read I feel like the most recent letters have trended kind of in this direction more so than I think they did in the past. There's particular words or comments that I find interesting in the letter. For example, like when he's talking about the Japanese investments, and he used the phrase like our holdings of the five are for the very long term, and we are committed to supporting their boards of directors. I always find it interesting when he says something like that in terms of who is he talking to when he's saying that, and what is the thought process behind that. Like, I just find all those things very interesting. I'm sure there is a logic to it from his perspective, but it all comes back to this idea of, and again, he's writing to an audience that is more general than probably a lot of the people who are listening to this podcast, right? We're a little bit more in the crazy fans. But he opens the letter by saying, a report has a certain amount of area it needs to cover, and it's beyond basically what's required, the required minimum. For me, I'd love when he then talks about even something that's trending in the right direction. It's something like Geico, when he talks about Todd Combs and a long held gem that needed major repolishing, as he puts it. Like, I would love to hear more on what happened there. I mean, I have a general idea in terms of telematics and some other things, but I'd love to hear a discussion about, what Berkshire missed, what they could have done differently, what role he played in that, or if any. Like, those discussions would be really interesting. And again, it doesn't have to be necessarily things that are negative. It could even be something that is turning around and working well. Like, why is it working well? Or, for example, I think the Rational Walk had an update on Berkshire's annual results. I think he did a good job of showing Geico by quarter, and I got the indication that they're now starting to ramp. They're starting to try to pick up policies again after a period of really getting their butts kicked here in the last, call it, especially the last 2 or 3 years, if I remember correctly. With the last 5 years or so, they've gotten demolished by Progressive on a relative basis. So again, I just think some of those discussions would be really, really interesting for people who are kind of deep on the business, and he doesn't have to do it in a way that's oversharing or negative, but it's just not the way he wants to do it, right?
Let me start a few things that were notable to me. And look, I read the letters once and then I never read them again. So maybe, if you read, I'm approaching the 40s at this point. If you read a letter once for 20 years, you kind of start to remember, but you might distort it or anything. But some things that jumped out to me. Just number one, he said, 2024, Berkshire did better than I expected. Though 53% of our 189 operating businesses reported a decline in earnings. And I kind of wanted to match that up with, there's been a lot of talk online about Berkshire's record cash position. He's not really buying a lot of stock these days. And I see lots of debate. Is Buffett bearish? Or is this just the new Berkshire, right? Like, the cash rolls in. And so when he said 2024 was better than I expected, even though over half their business reported declines, in my mind, I'm like, oh, it does feel like Buffett's bearish. Like, he's saying better than expected. He was probably thinking more businesses decline. Like, he was probably thinking we had a recession, and he's not deploying cash. So I want to pause there and get your thoughts on that, little macro take. Do you think I'm off? Would you have something different to say there?
No, and again, this hints at this line. It reminded me of, I should have pulled the specific language when he talked about Apple's repurchases a couple of years ago. He almost framed it in a way as if it was like free money, effectively, not actually accounting for the fact that obviously Apple is using their cash to make this happen. And he does this every once in a while with the way he discusses certain things. And this topic of how much of Berkshire's cash or assets is in businesses overall has become kind of this talking point. And the quote that I saw in the annual report that stood out to me was, while our ownership in marketable equities moved downward last year from $354 billion to $272 billion, the value of our non-quoted controlled equities increased somewhat and remains far greater than the value of the marketable portfolio. Well, the far greater part isn't really relevant to the question of what the equities bucket is doing necessarily. They're two distinct things, right? But he says the value increased somewhat. My point in saying this is in a year when the market went up very significantly, Berkshire's publicly traded equities portfolio decreased very significantly. And it's not like the value of the non-quoted controlled equities increased substantially, right? So it's just one of those things where, and I understand, I get it to some extent, but he kind of really avoided having the conversation and kind of used a reason that's not entirely logical for walking himself away from that discussion, right? But I do understand overall, hey, you got to think about this in the context of an entity that is worth a lot more than just the quoted value of the publicly traded equity. So I get what he's hinting at by doing that, and I can understand why he doesn't want to go into some of these discussions in too much detail.
ask you a big question. If we were clipping something out like hot take style and we're like, we need a minute clip, we need something to track the people, this is probably what I'd clip. But ignoring death, which Buffett is 93 right now, I mean, death is certainly a possibility in the next year. But if I told you, hey, next year Buffett's alive, but he doesn't write the annual letter next year, would it shock you if this was his final one?
It wouldn't shock me. You mentioned hot takes. As I was getting prepared for this a little bit, and I was listening to Jeff Gannon and Andrew Kuhn a little bit talk about the shareholder letter earlier this morning, I started thinking more and more that maybe at the meeting he announces that he's retiring. As I started to think that a little bit more as I thought about some of the things that have come out in the press of late, kind of some of the things he mentioned and how he wrote the letter. And then I think I might have read a little bit too much into like the timing of certain events at the meeting and even like the structure a little bit. I don't know. I might just be reading into all of this way too much, but I started to walk away thinking maybe the plan is to make an announcement in the morning at the meeting as they normally do with the earnings results. And he has the opportunity to talk about it a little bit. And then it's him and Greg on stage in the afternoon as a way to really give that the proper, if he's alive next year, would he come back up on stage? Who knows? But like maybe this is the way to kind of formally do it. Certainly seems like, I mean, how many times in the last 6 months has there been some mention of his age that he seems to have kind of been involved in 3 or 4 times?
And it wasn't lost on me. I've never heard or seen, I'm sure people knew, but he's 93. This is not a surprise. He's walking with a cane, but he mentions the cane thing. Like he's definitely setting himself up for older. It kind of struck me like there's the line, it won't be long before Greg replaces me as CEO and we'll be writing the annual letters. Yes, he said stuff like that before, but that was pretty direct. And I kind of thought, and then this letter, not that it's some incredible finale, but look, what does he say? The future of Berkshire is insurance. He talks about the insurance business and how to think about the insurance. He lays out the culture, right? He mentions the RV dealership, who they bought, they partner with. They didn't really haggle over it, but they buy it for a fair price. They give him a salary and he gets to grow the earnings. And they talk about trusting the partners, everything. Like it kind of was, to me, if this was your final, in hindsight, it would make a lot of sense. Like, hey, we set the culture. The future is insurance. If you're buying this, you're buying the insurance and some great businesses. And we largely bet on America. And he even had that thing where he said the American government needs to work to maintain I think it was stable policy or a fertile field or something. I was like, oh, he's hoping there are a couple of senators or representatives from Nebraska who are reading this and remember, you got to keep things somewhat stable.
Yeah. Well, as someone who was hoping to be involved with selling my book downstairs at the annual meeting, it also does strike me as maybe slightly notable that understandably last year, given what happened to Charlie, that Poor Charlie's Almanac was the only book at the meeting. Now this year, again, they're only going to have one book at the meeting, and it's basically a book about the last 60 years that Berkshire had. It's tying, and granted, they did this book 10 years ago, 50 years of Berkshire Hathaway. So maybe it's just time going by and these things happen. But yeah, I got the sense from reading it that it felt like more of, and also in combination with some of the news that we've seen lately, it just seems like more of a setting us up for the future.
You know what you need to do? Just like when you go to a baseball game, basketball game, whatever, there's the official merchandise inside, but there's the guys hawking the illegal knockoff merchandise outside. You got to be selling those illegal knockoff books outside, hustling. Hey man, you want a copy of a Berkshire book? Unauthorized.
Yeah, Warren's in his 90s, but he still probably would make sure that nobody's doing any economic activity near the meeting without him getting his cut.
One thing that jumped out to me. So again, I was having in the back of my head, hey, is this Warren's final letter setting up for a passover to kind of Greg? One thing that jumped out to me, he mentions Todd twice when it comes to Geico, does not mention Ted at all. I can't remember, but I think this is notable. 3 years ago, he's mentioning Todd and Ted quite constantly, and he's really backed off that. Now, this is his last letter, part of it might be culture setter, right? Berkshire is too big. 5 years from now, Berkshire, yes, the portfolio will matter, but it's going to be operating businesses, P&C, and probably dividends and share buybacks, right? Like equity investments won't matter. So maybe if this is the last letter, he's setting up for culture setting. But it also struck me, when he brought these guys in, it was, here are the handpicked lieutenants. People talked about, I think particularly Todd, given his Geico role, could he be the next CEO? He had talked about how these guys were going to allocate capital, and just no real mention of them allocating capital in the letter. I could speculate endlessly, but I'd love to get your takes on that.
No, I think it's a fair point. I mean, again, we have a couple of mixed signals, right? We have the repurchase activity has completely dried up as of the fourth quarter. It was immaterial in the third quarter. It was either $10 million or $100 million. I can't remember the number now, but very small. Last 12 months was the lowest dollar amount of repurchases that Berkshire's committed to since they started really repurchasing shares. And I believe it was Q2 or Q3 of 18. So, there is some component of that here. But I do think in general that there is something that's coming most likely in terms of capital allocation that's going to be a pretty significant change from what we've seen historically at Berkshire. What exactly that is, I'm not sure. But again, it's just there's these positions. The question I wrote in a question to Becky, because it says you can do so at the end of the letter. And one of the thing I wrote in about was Coca-Cola, and just thinking about, they've held this position for the last time Warren touched it was in 1994. They've held it for more than 30 years without us buying or selling a single share. And as we go forward, and again, like I referenced the Japanese companies, is this effectively a similar position where, Warren, his belief is that effectively don't even have to bother looking at it again. It's something we're going to hold in perpetuity. Or is there some other frame of reference to think about how Berkshire is going to be managed going forward? I mean, that's somewhat of an extreme example, but I do think there's a case to be made that, and this is also a fair knock, I think, against Warren to some extent, that they've kind of set the rules in terms of how they're going to judge themselves on holding whatever we're calling, quote unquote, excess cash as kind of like a 5-year test is the number that they've said previously. And I think in some ways we're past that in terms of some amount of cash in the balance sheet that feels, above that. And I just really struggle to think that as this goes to the next generation of leaders, that's going to be a continued approach that Berkshire operates with. That just strikes me as pretty unlikely.
Look, I mean, honestly, they can't, right? And it is interesting you say that, because I believe Buffett in this letter has the old, hey, somebody snuck in and got that dividend out in 1967, but he said our partners have trusted us to reinvest, so we've reinvested really sensibly. But I think he sets the stage for you can't do it anymore, because if they reinvested everything they did for the next 10 years, I mean, just because of the amount of cash they throw off, this thing is going to trade for an enormous conglomerate discount. Because at some point you're just like, hey, all the operating earnings sits in cash, and eventually you're like, cool, this is a $2 trillion company with, 800 billion in cash, like that has to trade for a discount. It's incredibly inefficient, right? And especially when it's no longer Warren Buffett. First, if it was no longer Warren Buffett, or even if it was a 104-year-old Warren Buffett. But second, like 800 billion cash, you can't deploy that even in the financial crisis. You can't deploy 800 billion or something, so it has to change at some point.
Yeah. I mean, a notable thing from last year, they bought the remainder of Berkshire Hathaway Energy. Like there's still things it was $3 billion to buy the last, or $2.9 billion to buy the last 8% of, if it's under Warren's watch, that obviously would be perceived differently if Berkshire, are these even feasible? But went out and tried to buy the remainder of American Express or something like that they own a very significant equity stake in, and obviously plan on owning for a long time. I really struggle to think that any of the new managers, whether it's Greg or the investment managers, would 6 months into the job, sign a check for 200 billion or something. But maybe it'll happen. We'll see.
American Express is an interesting one, because great brand. There's going to be a future there. I know at some points I've never doubted that there's a real place for the credit card companies, but I have wondered about American Express versus like a Visa and MasterCard, just because American Express is the premium player as things go more online, and you kind of lose the cachet of you whip out the Amex card. But that's an interesting one. I do wonder, like, regulatorily, if they're already regulated, they're already huge, but you throw Amex in there, now you've got you're a bank. It's an interesting thought.
Well, and they already own 21% of it, by the way. Like their interest in the company is already pretty darn significant. So
true, but you own the whole thing, and the regulation's a lot different than if you own 21%, because you're systemic.
Sure.
If you own the whole thing, and Berkshire, earthquake in New York City destroyed $1 trillion of reinsurance damage, and then Amex is at risk or something. That's a little more systemic than, and obviously they structure and everything, but I think there would be a lot of thought of how big is too big at that point.
Apple was really like the perfect. I mean, obviously, it was a fantastic investment, but it was really like the perfect publicly traded company for, obviously, because it was so big, right? It was a perfectly publicly traded company for them to take a relatively small minority stake in and to have an investment in. But like that game it's even harder now than it was, how many years ago was that? 9 years ago? I mean, the size of Berkshire.
17, I think. 17. So yeah, about
16 or 17, something like that. So just, again, you're in the world of investing in publicly traded companies and having an investment that's meaningful to Berkshire without being a very significant percentage of that company. The size of that universe is just shrunk to an incredibly small level. So
A reminder that today's podcast is sponsored by Fintool.com, the ChatGPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com.
Let me ask about a specific name that earlier I asked you about the potential bearishness of Berkshire. And one name that jumps out to me is, if you remember 18 months ago, Occidental, the ticker is OXY, had the Buffett put, people like to call it, right? Every time, if I remember correctly, every time Occidental would drop below 60, Buffett was, literally hundreds of millions of dollars of open market purchases every time Occidental would drop below 60. Today, as you and I are speaking, Occidental is probably around 45, 48, somewhere in that range, mid to high 40s. You're not really seeing any insider buying from Buffett. Like, they've stopped. He did a small one sometime earlier this month, but 18 months ago, it was daily. You were getting 4 and 4s for hundreds of millions of dollars. Now it's once a quarter. He maybe buys $10 million the entire quarter or something. And I'm just interested in that because he's had very high praise for Occidental and the assets before. The price is a lot cheaper. Berkshire operates on a much longer time horizon than anyone else, right? So if he thinks, I'm a little surprised if he was buying in 2023 at 60 and today's the price is 48. I understand energy markets are a little different, but he's too big to play like, I think macro is going to accelerate or decelerate in the next 6 months. If he thought 48 was a bargain, if he was positive, he'd be slamming the money down, I would feel like. So I just wanted to ask you about that particular one because I think it's very interesting.
I have not followed the situation particularly closely, but my two best guesses would be, one, if they feel there's a explicit or some other reason to think they have a limit on how large they can go on the ownership of the entity, which speaks to what we're talking about. Like, if you're really limited at putting more dollars in. My other guess would be, which I don't know this for sure, but I thought I'd heard something about basically M&A at Oxy. If they changed the capital allocation priorities from what they had basically publicly communicated, I think that's something that, generally speaking, he would look at as a negative. And
both of those could be correct. I am with you. I haven't followed it as closely as when it was fun 18 months ago where the stock would go below 60 and everybody would be like, now's the time to buy because Buffett's coming in. But it's just one, as I was prepping for it, I was like, oh, let me go see, because energy markets have been pretty soft recently, and Oxy's got a lot of great assets inside of it. They've got a chem play. They've got a lot of, and he's not buying. So that was just kind of surprising to me.
Yeah, it looks like they announced an acquisition in late 23. I don't know when he stopped buying, but announced an acquisition in late 23 for $12 billion. So again, I don't know if he may have very well been supportive of that deal for all I know, but my sense on having looked at the annual meetings and thought a lot more about what really drives Warren's decision making, and PetroChina is obviously a very prominent example from the industry, right? That fits the same kind of narrative. If he then got a signal that management was, because I think Oxy explicitly had kind of output growth targets in terms of caps of how much they're going to grow, which, generally speaking, people think of that as a negative. And I think Warren looks at that as a positive. And to the extent that they then, amended that in some way, he may have decided it's time to pull back a little bit.
Let me go one line I liked. I don't know if I've got crazy takeaways, but I'll give a mini anecdote with this. I really enjoyed his line where he said, I'm willing to admit my mistakes. And if you read the annual letters of any other company, there's no mistakes that get admitted. He did call out Amazon as a notable exception, which I thought was very interesting. But I really like that because, look, I deal in a lot of really small, shitty co's. And I was talking to one board, and it was clear to me the company's a flaming disaster, and a lot of it is caused by the board and management team. And I wasn't being mean, but guys, the stock's down 90% in a year. And, the call started off with 10 minutes of the CEO talking about how great things were going and how great operations were. And I was like, what world are these people living in? And I think it impacted my relationship with them because I was like, guys, yeah, you guys are doing fine because all the board of directors makes $200,000 per year, but I don't know what world they're living in, and they can't admit mistakes. And I just thought that was refreshing. So I'll pause there. You can comment on my anecdote, but I just thought it was a really interesting line from Berkshire, lightly repudiate everyone else who's not willing to admit these things.
Yeah, and it speaks to, Warren's position at Berkshire. It speaks to, in my mind, speaking of Amazon, it speaks to the Jeff Bezos, the story of rock concert versus a ballet. Like you have to run it for what you want it to be, and you're going to get the people that you deserve over enough time as a CEO. Now, that said, a lot of CEOs come into public companies and do not have that leash, or at least probably feel like they don't have that leash. I'm thinking of a company like Match Group that I follow. They're under the gun from activist investors. They need to do the activist investors are sending a letter to the company saying, hey, basically, you can't turn around these results in 6, 12, 18 months, whatever the number is, that you need to sell it. So when you're operating from that perspective, it's not too surprising that CEO then turns around and goes, I think I'm going to keep my bad news to myself and I'm going to talk about things that are so. But I think at one extreme, that's kind of what happens. And Warren has earned that. And, Berkshire is positioned in the way because he built it like this. And obviously he's done a fantastic job. That certainly helps too. But I think that's a huge part of that way of thinking. Again, coming back to what I was saying before, I'd really like, as a shareholder who's obsessed with Berkshire and follows Warren's actions very closely, to have a more concrete understanding of what he means when he says that. I mean, there's prominent times throughout history, and I talk about it in the book, like when he, at the 2006 meeting, basically says, I did make a mistake by not acting on Coke when it traded at XYZ price in 2000. There are not a ton of examples like that throughout Berkshire's history. And again, that's not a comment about Coca-Cola, right? He's just talking about his own actions. I wish he gave himself a little more leeway at times to talk about things of that nature. And again, Geico to me is a really prominent example in this meeting where, why did the need for major repolishing, to use his words, where did that arise from for a company that for so long was the perfect example of a Berkshire gem that was just trucking along each and every year towards a better and better place over time. There's a lot to be learned from that. So I wish at times that, and he does it to some extent at the meetings, which speaks to why I wrote the book. But it just doesn't happen as much in the letters or some other places.
No, completely. I mean, the meetings, how many times have we heard about Dexter shoes at the meeting? It's, I want to ask you quickly, he calls out Amazon and he says their 2021 report is a notable exception of people and of someone calling out their own mistakes. I just thought that was interesting because, yes, Buffett reads very widely. No one doubts that. But the space in this letter it's precious retail, right? He knows it's going to be read by all of his shareholders. This is getting edited. I'm not sure if Carol Loomis is still editing these or not, but these are getting edited. A lot of thoughts going into it. And in the same way, do you watch Severance at all?
I do not.
Oh my God, I love Severance. But Severance is one of those, law style mystery shows. And if they take the time to show you something, especially if they show it twice, there's a reason, right? Like every second is pressure on this. And when you've got 13 pages to devote to specifically call out Amazon in 2021, it's 2025 now. Was there a reason for that? I was curious just by him specifically calling out that company.
Yeah, the short answer is I still haven't been able to figure out what the reason was.
I want to read the tea leaves, man. I want to read the tea leaves.
I mean,
Amazon's
do
a
too.
huge company, name brand. it was interesting to me, the specific call out, Buffett plays on a lot of different levels, and you've seen this in the past. I mentioned the thing where he gently nudges the U.S. government, like, "Hey, we need to keep the dollar, like, it's sustainable." Like, he's playing on a lot of different games. That's obviously a call to politicians. Calling out Amazon here was interesting.
And even to your point, right? It almost would make more sense for him to write it as, Andy Jassy, the CEO of Amazon, has been one example of someone who's done this. The fact that he specifically called out 2021 was just kind of, there's something about it that I'm not too sure why, but it seems interesting.
During the letter, he mentions, "Hey, when I was prepping for this letter, I called up it's a woman, and I asked about their step grandfather, and I asked them how deep into schooling they got, and they told me he got to the 6th grade." And I was just wondering, if I wanted to ask you how far into school your grandparents got, or your would you be able to answer that off the top of your head?
No.
I was just mystified by that. I was like, oh, maybe do people have deeper family connections than I do? Like, what's going on here?
That section is a good example of, again, it was just some parts of this, like he just randomly talked about CEOs and whether or not they went to, Ivy League schools. It's just a funny thing to throw into the letter that I'm not sure what made him decide that he wanted to put that in there this year, but he decided he wanted to put it in there this year. It's just interesting.
I want to go on a quick rant. We've talked several times so far about the Japanese holdings, and the Japanese holdings have been great, right? He's done almost a double inside of, 5 years since he started, almost a double, got dividend. Like, it's been a really nice investment. Anyone would take almost a double in 5 years, but especially at his size, that's awesome. There was one thing I took issue with, and I saw a lot of people praising him. He said, "Hey, our Japanese investments will get $812 million in dividends from them, and the interest cost is $135 million. And look, it's great. No one doubts it's great. It's great. But I could that is the type of thing I feel like I would see on Twitter, where somebody's like, "Hey, my dividend yielding portfolio, we could go borrow margin." And nothing on this is financial advice. I'm just saying this to illustrate the insanity of it. I did a quick look. Margin on IBKR is 4.85% or something off the top of my head. The top 5 yielding companies in the S&P 500, which if I showed them to you, you'd be like, "Oh, those are all probably pretty interesting value stocks." They yield about 7% and growing. It's where's my little list? I'll tell it to you. Where's my ChatGPT? I asked ChatGPT. I'm trying to get better. Top yielding companies. Altria, nobody hates that. Progressive, we've been talking about Geico, great business. That's a 7.3% dividend yield. Altria is 8%. Dow, historic chemical company. LyondellBasell, okay, you've got some cyclicality there, but those are yielding over 7%. Crown Castle, 7%. And for fun, I'll throw in Verizon at 7% and Pfizer at 6.5%. So, we could go buy those. We throw $50 million into those, take out a margin loan, and then we could be saying, "Hey, the margin debt that we pay, we're paying $2.5 million. We're getting $4 million in dividends and growing." Like, it sounded like something somebody would say. It's just like, I understand why I did it, but it was very financially unsophisticated, and people just lapped it up. And it's a fantastic investment. I'm not doubting that, but I was just surprised he put that in there, because here's the thing: you take both sides of the risk, right? And I was just very surprised by that.
Yeah, I mean, obviously the structure of the yen-denominated debt that they raise is slightly different than margin loans. But
well, true. There's no call protection, but here's the other thing: margin loans you can pay up and down like that. If his investments go to shit and he sells them, right, for any reason, right, he sells them, then he's stuck there and he can't pay that cash. He's got to wait till those bonds come callable, and so. You could be looking, there's a scenario where you reverse it. Look, he's Warren Buffett. He's basically an investing god. I understand it's probably not going to happen, but if something bad happened to one of those companies, you could be sitting there looking at, okay, cool, I'm down 60%. I had to sell. I've got cash less than the value of the debt, and I've got to pay interest costs on this debt for another 10 years. And by the way, the reason you're borrowing at such great interest rates is because you're an incredible credit, right? So you're borrowing at AAA interest rates. I didn't like it.
Yeah, I mean, I get what you're saying. Again, the part that really jumps out to me is, I mean, I'm just eyeballing it now. It basically takes up a page of, there's 11 pages of kind of like meat in the letter. The remainder is talking about the annual meeting. And I'm confused why it's an interesting thing to update on, and I get it. but it's 23.5 billion of market value on north of $1 trillion worth of assets at Berkshire. And again, like, it's fine to talk about this. I just wish that when we go through the sections on, Burlington Northern and BHE, that the conversation is a bit more than, I'm going to pull it up right now just so I can, Berkshire's railroad and utility operations are two largest businesses outside of insurance, improve their aggregate earnings. Both, however, have much left to accomplish. Like, so we got two sentences about, and I get it. It's he wants to approach us a certain way, but to the extent that this is maybe the final letter, it would have been nice to have, again, like the reassurance of, and this is part of people love the meeting, right? To hear Warren say, in a lot of cases, something he said 20 or 30 years in a row in a slightly different way. But it is nice to hear him say it, that, hey, here's the lay of the land on Berkshire Hathaway Energy. Here's what happened last year and where the discussions about, what's happening with wildfires and other things from a regulatory perspective. He'd obviously have to massage the language in a certain way for it to be okay with the stakeholders in that business, right? But there is a way for him to talk about some of these things, or at BNSF, like, is the operating ratio, should people, outside investors who he's writing to, be hyper focused on the fact that the gap to UNP is consistently 5, 6, 7, 800 basis points of OR differential, or is that the wrong way to think about this for some reason? Like, those things would be really, really helpful. And again, like, just in a general sense, he can still stick to his rule of not doing things by name in an overly, aggressive way. I just wish we had a little bit more of that at times, because it seems like we haven't had that for quite a while.
And to yes and what you said, like, look, their position in Apple is 75 billion, and the Japanese stakes overall are 25 billion. So great trade, but look, versus Apple, each one of those is about 4 billion, right? So versus Apple, each one of your Japanese positions, and I understand their basket and everything, is worth about the daily move in Apple, So
yeah,
it was an interesting trade. And as you said, he took a lot of time to invest it. I think he's maybe prepping for, he wants to buy more in Japan. Wouldn't surprise me. Or maybe he's prepping for, he did mention a few times, most of our stuff's going to be American. There's going to be some international. So maybe he's prepping for a big international acquisition. Or you know what? The man's had a great career. Maybe he just wants to spike the football one more time. Been talking about 45 minutes. Anything, I think we've gone through most of the letter. Anything else jump out to you that you thought was interesting, not interesting, you think people should be thinking about?
I mean, I think one thing that I guess it's discussed a little bit in the letter, more so in the annual report, just the results in the insurance business and sitting here with this significant amount of liquidity for a long time. And if it got to a period eventually where it felt like rates were never going to go up, right? And, you now look at this period where I pulled the numbers, the insurance business from 2010 to 2020, the average pre-tax underwriting gain plus net interest income was roughly $5 billion a year over that period from 2010 to 2020. In 2024, that total was $25 billion. It was 5 times higher it was a great year in terms of insurance underwriting. Geico had very impressive results, which now sets
some
the stage
acquisitions
for,
in between now and then as well. So yeah, but it's huge. And again, but 1 year of operating profits there bigger than the Japanese profits over the Japanese positions. So
yeah, NII in the insurance business went from 5 billion in 2020 to nearly 14 billion this year. And again, it's another thing that warns. I believe it was a 2012 letter where he said, float probably won't grow. It was 11 or 12. It won't grow from here very much. It might decline 1 to 2% a year or something. Fast forward to today, float's at 171 billion, and at 2010, it was at 66 billion. So continued growth in float has also been, a nice tailwind. And as he noted in the letter, over the long term, they've, eked out 3.5 cents or something like that per dollar of premium volume in terms of underwriting profit. So it is really nice to, the next question will be, to the extent that a G is directly responsible for a decent chunk of these businesses, or someone like Todd needing to come in at Geico, how sustainable are some of these advantages? And that'll be an ongoing discussion. And some of these discussions will probably become more pointed when Warren's not here, right?
Do you think Warren, last question, this would be my other hot take question. And I was thinking about it before, but it kind of just popped out. Do you think Warren's okay with the Class A, Class B structure that Berkshire has right now, or do you think he might try to flip it before he dies?
That's it. And flip it in terms of what would be the rationale. Is there a main reason why I'd want to do so that you're thinking of?
Yeah, look, Berkshire's huge. There's no doubt about that. But how many A versus B shares are there at this point? I should have come ready to.
I can pull it up while you're.
Yeah. So imagine Berkshire is a $2 trillion company, and you could imagine 20 years from now where 5%, because A's can flip into B's and not the other way around, right? So you could imagine 20 years from now, it's a $4 trillion company. Like, name your number, but 5% of it is from the Class A stock and 95% is from the Class B stock. So $4 trillion company, let's make it easy, $5 trillion company, 5%. So $250 billion is in the Class A's, and then $4.75 billion is in the Class B's. Well, all of a sudden, you've got a scenario where an unscrupulous person, now they'd have to be quite rich, but I can think of one very rich person who I think is kind of unscrupulous, who could be that, all of a sudden, hey, if they can raise $75 billion, if they're worth $75 billion, and if you think about it, 20 years from now, that $75 billion will still be a ton, but there will be people with $75 billion. They can raise $75 billion. They go take on another $25 billion debt. All of a sudden, they could have control with $100 billion. They could have control of $5 trillion of market cap, right? So you get a lot of leverage on that, and then you can install yourself, and then you can turn Berkshire into effectively a closed-end fund where you're paying 220, and like nobody can kind of stop you, right? So I wonder if I was Warren, I would probably eliminate the dual class structure before I passed. Now I know he's giving it to his kids, but Warren does think about the long game. And guess what? His kids, because he's 94, his kids are pretty old too. Like I'd really be thinking about how do I want to have that risk? And maybe he doesn't care. Maybe that's for people. But one worry I have is Berkshire could very easily trade at a huge conglomerate discount, or it could trade at it like 10 years from now if the people aren't doing right, or people could take control of this and like really run amok here.
Yeah. Okay. Now that you're saying, I'm remembering slightly some of those structures where he's quantified basically some period of time where it's going to be in control of friendly hands. But yeah, to your point, that obviously will change over time. And honestly, my answer to it all is to the extent that if it ever gets to a place where that actually is not there is a scenario where it's actually necessary, right? Like not everything that comes in the form of activism or change is necessarily nefarious. So, Berkshire as an entity is constrained in some pretty significant ways. And, it's upon the next managers to find a way to manage this thing in a way that makes sense and that works for shareholders, and that doesn't work better in some other structure, right? So I do think that'll probably be a reality to some extent in over the course of enough time, right? I mean, it's going to take a while for this to get there, but I think that'll be the reality of the entity. And, I think they do have some opportunities at their disposal to the extent that they wanted to get smaller or to focus in some areas that they could try and do that, but it's going to require some capital allocation decisions that are quite different, obviously, than what Berkshire did for a very, very long time. And even including the repurchases, it's still been a smaller part of Berkshire's overall capital allocation priorities over the last decade or so. So yeah, there's, it's going to be really challenging. And they're going to have to find a path forward.
A reminder that today's podcast is sponsored by Fintool.com, the ChatGPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com.
Buffett has historically been an incredible judge of shareholder value, right? Not shareholder value, yes, but also of people's character. So there is something to that. But look, I could imagine a scenario where people are one way around Warren while he's alive, and then he trusts them, and then they pass the class, they get the controlling stake, and maybe even it's not instant, but there are a lot of people who we're talking 2025, their views are a lot different than they were 5 years ago, and a person controlling the Class B for 5 years. I look at John Malone. John Malone, he's giving a lot of his lieutenants his Class B shares. He said this 4 or 5 years ago. He's giving a lot of his lieutenants who he trusts his Class B shares. And I do look at some of the moves Liberty has made over the past year. And I wonder if Malone was looking around saying, hey, I don't know if I can trust these guys who I was going to give my Class B shares. Maybe it's I can't trust them because I'm worried they're going to self-deal. Maybe it's I can't trust them because I don't think they're as good as I once thought they were, or they lost a step or something. Or maybe it's just, hey, why am I bothering with this? Let's just wrap this all up. I'm John Malone. The candy shop is always open. It's time to sell. But I wonder about that with Warren, because Berkshire is going to be a really big company, and it's going to take a big check, but nowhere close to as big a check to get control. And if you're like, hey, Andrew, here's a $200 billion check, Warren's not around, how can you create a lot of value? One way I'd tell you is we could go take Berkshire over and we could, install a 2.20 fee on it and start paying ourselves. You can get pretty spicy there.
Yeah, this is where, coming back to some of who's Warren talking to in certain sections of the letter, and I believe it was the Wall Street Journal had this article basically about Howard Buffett and the future of Berkshire that not too long ago, maybe in the past 6 months. But the first page of the letter includes a decent batting average in personnel decisions is all it can be hoped for. The cardinal sin is delaying the correction of mistakes, or what Charlie would call thumb sucking. Problems, he would tell me, cannot be wished away. They require action, however uncomfortable that may be. I mean, for Warren to say he's had a decent batting average when, the comment in other meetings has been basically, we've never had a manager lead Berkshire. They've fired some people along the way or asked to leave. But generally speaking, I think their personnel decisions have probably been pretty darn good, at least in terms of like the really important ones, right? Maybe not a perfect record, but for him to say, a decent batting average, it's just an interesting reminder of like, hey, if things are not going the way that they or should be going, then we need someone who's willing to make very tough decisions. And I think he's basically explicitly said at times that he's entrusting his son to do that. So that is what Berkshire is. And if people don't like it, then they should probably take action.
All right, you know what? Just quickly. Oh, I can't get it. I have the book here, but it's under. There you go. My copy is there. It's still got a lot of markings, but it's under a protein powder jar, and I just can't get it out right now. But Alex, any last thoughts before we wrap this up? And any thoughts, Berkshire related or otherwise?
No, I greatly enjoy you having me back on the pod. I will be wearing my shirt next time. I'm excited.
All right, I thought I had sent you one. I'm gonna make sure we get you one sent. And yeah, Alex Morris, Buffett and Munger Unscripted. You can buy it on your favorite bookstores, probably Amazon. If you're interested, check out The Science of Hitting. And thanks for coming on. Looking forward to. I think we're at least doing a panel of some form on media in the summer. So I'll talk to you hopefully before then. But people will hear us talk then, if not before. So cool, Alex Morris. Thanks again.
Thank you. Appreciate it. Thank you.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.